Why are long bonds up after the Fed rate cut? And how high could the 10-year T-note go? Hello, members, super savers, and bond course fans. I hope you're healthy and well. And welcome back to part 2 of our 2-part Fed rate cut series, which we've combined with our weekly update this time. So, long bond yields have risen nicely since the Fed announced its jumbo 50 basis point rate cut this past week. This is where yields stood about 90 minutes after the Fed rate cut announcement. While short-term rates went down as expected, they were all up on the long end. And this rise for longer maturities continued the following day, which seems to have surprised quite a number of folks, especially some of you who own TLT. TLT is iShares' 20-plus year Treasury bond ETF. Now, as we all know, yields up means prices down for bonds. And because the yields for the 20-plus year bonds in TLT went up, its price went down, meaning losses for TLT owners, at least on paper. With that in mind, here are the 3 topics that we'll be covering in today's video. And for those of you who've missed it, I've linked part 1 of our Fed rate cut mini-series in the first pinned comment below. So, 1. Why might the Fed rate cut be good for long bond buyers? And how high could the 10-year Treasury note go if the Fed's plan works? And yes, we will be diving further into the Fed's plan here. 2. Where did Treasury yields end this past week after the initial noise from the larger than expected rate cut settled down? We'll be looking at both the short end and the long end here. And 3. What's on the upcoming Treasury auction schedule? And where can you find the best opportunities with new issue agencies, corporates, and brokered CDs now? As usual, here's our front of video disclaimer. For a detailed disclaimer, please refer to the end of this video. Let's dive in now, folks. So, we posted a community poll right after the Fed announced its first rate cut in 4 years, asking you what you thought about their 50 basis point rate cut decision. And the results were fairly mixed. 39% of you thought it was the right move. 54% of you thought they should have cut by 25 basis points only. And the other 7% had a range of different views, from not cutting at all to even raising rates by 100 basis points. But what really surprised some of you, as I mentioned at the start of the video, was that even though the Fed decided to cut the Fed funds rate by 50 basis points, rates on longer dated treasuries actually went up immediately afterwards. In fact, yields on all treasuries with maturities longer than 2 years ended up for the week. But more on those numbers in the next section of this video. For now, let's talk about why this is happening and answer the question, why might the Fed's recent rate cut be good for long bond buyers? To answer this question, we need to first understand why a normal yield curve would ever invert, and why an inverted yield curve is often associated with an oncoming recession. Remember that an inverted yield curve like the one we still have at the time of this taping just means that shorter dated bonds are yielding more than longer dated bonds overall. Which at market close on Friday meant, for example, that the 3-month T-bill paid 4.75%, while the 10-year Treasury paid only 3.73%, even though you lend out your money for much longer. So here's a high-level overview of inverted yield curves and recessions. Bond masters, folks, please refer back to Module 3, Video A, for a refresh on anything we're about to cover, and the rest of the videos in Module 3 if you need a brush up on how bond strategies may differ depending on the yield curve environment. In the beginning, the Fed raises short-term interest rates, usually to bring down inflation. At this point, the yield curve is still normal, not inverted. Problems arise when the Fed raises interest rates so high and or so fast that investors think they will slow down the economy because the more expensive it is to borrow, the fewer loans businesses and consumers will take out for immediate use and or future investment. The yield curve inverts when investors fear that the economic slowdown from higher short-term rates will be so strong that it will lead to recession. And when a recession happens, the thinking is that the Fed will have to cut rates and fast to stimulate economic growth, which would then cause the inverted yield curve to uninvert, to become normal again, basically, usually with the short end coming down by a lot and the long end coming down as well, but by less than the short end. And that's one of the main reasons why an inverted yield curve is often seen as a predictor, a sign of an oncoming recession. But what if there is no recession? What if there's a soft landing? Because a soft landing, rather than a recession, is where the FOMC seems to think we're heading. According to Fed Governor Powell, recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. He goes on to say that FOMC participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. So, what if the Fed does manage a soft landing and our economy continues to grow at a stable pace rather than falter? If there's no recession and the Fed doesn't have to cut rates fast, how else could the yield curve uninvert if it's not by all rates coming down across the board? Well, as I've mentioned in a number of our live member Q&As, one possible scenario could be that the short end comes down, but slower than expected, and the long end stays where it is, or possibly even goes a bit higher from where it's been. And that's what we may be seeing with this recent bump up in long bond yields. Because it appears to us that's what's been priced into the bond market to date, why the yield curve is still inverted, is due to ongoing recessionary fears, not soft landing cheers. But if we could achieve a soft landing, there would be no recession, and the Fed would not need to cut short-term rates down to the bone. Instead, it could let rates stabilize at a level that will be closer to long-term averages. So, let's take a look at where long bond yields could end up after such a soft landing scenario. Here we can see the FOMC's latest target Fed funds rate projections from their most recent September meeting for the end of 2024, 2025, 2026, and 2027. These are based off of the official estimates that the FOMC itself puts out for where they think that rates may go over the next few years. Now, FOMC members don't have a crystal ball either, and they have been known to be wrong before. But this is still the best insight into what they're currently thinking, and in that sense, not a bad starting point. And yes, they see rates coming down over the next year or so, but then stabilizing quickly at a bit above 3%. Down here now, this column shows the starting year for our long bond yield analysis. This column shows the average spread, the difference basically between the 10-year T-note and the Fed funds rate from this starting year to the time of this taping, excluding all inverted yield curve periods. Because remember, we're looking at a soft landing scenario. No recession, no inverted yield curve. And this section shows the projected 10-year T-note yield at the end of 2024, 2025, 2026, and 2027 based on these numbers here. So, for example, if we use 1984 as the starting year, the average spread or difference between the 10-year T-note and the Fed funds rate between 1984 and the time of this taping, excluding all inverted yield curve periods, is 1.8%. Add this 1.8% to the latest target Fed funds rate projection of 4.51% at the end of 2024, and we get to a projected 10-year T-note yield of 6.31% at the end of 2024. If we use 1994 as the starting year, the average spread or difference between the 10-year T-note and the Fed funds rate between 1994 and the time of this taping, excluding all inverted yield curve periods, is 1.71%. Add this 1.71% to the latest target Fed funds rate projection of 4.51% at the end of 2024, and we get to a projected 10-year T-note yield of 6.22% at the end of 2024. Of course, this is a wide range of estimates for the 10-year T-note yield, but the most important thing to note here is that under a soft landing scenario, even the lowest projection here, 5.8%, is quite a bit higher than the 3.73% that the 10-year T-note ended at the end of last week. This isn't what we were initially expecting, at least not in this magnitude. So we cross-checked our analysis with a similar one, comparing the 10-year T-note versus the 2-year T-note, which came in with numbers closer to between 4.36% and 4.82%. However, regardless of whether we use the Fed funds rate or the 2-year T-note as the basis for our analysis, and no matter which year we start with, the end result is similar. The 10-year T-note and along with it, longer dated bonds should be yielding higher if the Fed does manage a soft landing and the market believes it. And in our mind, that is why long bond yields have been trending up since the Fed's rate cut decision, because the market may be realizing or hoping that if there's no recession, then there may not be a need to cut rates fast and deep on the short end, which means that rates on the long end may not necessarily have to come back as they usually would under a typical inverted yield curve recession scenario. Now, keep in mind that all the numbers we've shared with you here today assume that the Fed actually achieves a soft landing, which appears to be the Fed's current plan, or at least hope. And it would be good for our nation, our economy, and all of us if we could avoid a recession. But it's also clearly not a done deal yet. And in the past, many, if not most, inverted yield curves have ended in recessions. And if a recession does happen, and or if there are external shocks to the system, then short-term rates could go down much faster and much deeper than we expect. And long-term rates would most likely fall along with them. Also, as we've shown in the first part of our mini-series, Treasury rates on the long end can sometimes take on a life of their own and do not always track the Fed funds rate closely and could behave differently for a variety of reasons this time around. Another risk is that lower rates may still reignite inflation and may not do much to help bring government spending under control, as I know many in our Diamond NestEgg community are rightly worried about. Based on the latest economic data, though, and specifically how far down inflation has come this year, I do think that the Fed can build a case for aiming at a soft landing while simultaneously keeping inflation under control, as they seem to have done with their rate cut decision. As for the budget deficit, it clearly remains one of the big economic risks for our country, and we'll continue to watch it very carefully here as we approach the November election. So stay tuned. Because as I've said before, I do believe that there will be ongoing uncertainty and volatility in the bond market as traders and other participants continue to play guessing games with the Fed and make bets on each new piece of economic data that comes out nearly every week. So my general thoughts for those of you who are retired, about to retire, or who just want to lock in some longer-term yields so that you can sleep better at night is as it has been since last year. Don't try to time the market with your life savings, but trust in the power of diversification where you can. Continue dollar cost averaging into your fixed income holdings while maintaining some dry powder, if possible, for anything opportunistic which may pop up along the way. And if you're interested in continuing the yield outlook and general fixed income discussions further, come join our next live member Q&A today, September 22nd at 5 p.m. Eastern Time, 2 p.m. Pacific Time, or watch the replay in our member zone afterwards. Now, let's move on to the next section of today's video. So let's see where we stand at the end of this eventful week in the bond market and compare Treasury yields from this past Friday versus the previous week. Here we have all the maturities that the Treasury issues at auction. Here's where yields stood this past Friday, and here's where yields stood at the end of the previous week. As you can see in our Diamond NestEgg table, Treasury yields were down again and quite significantly on the shorter end of the maturity spectrum. Everything above 2 years, though, was up for all the reasons we just talked about in the first half of this video. Now, let's take a look at Treasury yields from this past Friday versus the beginning of this year. This row shows where rates ended this past Friday. This row shows where rates were on January 2nd. And this row shows the increase or decrease in rates since the beginning of this year to the time of this taping. Decreases in rates are shown in red. Treasury yields across all maturities are still lower than where they were at the start of the year. The 30-year, though, is almost break even at -1 basis point. While at the shorter end, the 6-month is down by 81 basis points, and the 1 year is down by a whopping 88 basis points. Again, this means that the yield curve continues to uninvert. So while short-term treasuries still pay higher rates than longer maturities, the difference to longer maturities has definitely come down. You can find more details on these rates for any day of the week that the bond market is open on the Treasury's daily Treasury par yield curve rates page. All sources are linked below in the first pinned comment. Do keep in mind that this overview gives you a general feeling for where rates currently stand along the maturity spectrum. The yields that you may get when you buy at a specific auction or from a specific broker, or when you sell, will likely differ a little bit from what's shown here. Now that we've covered Treasury yields from this past week, let's move on to the next section of this video, especially for those of you who are interested in agencies, corporates, and brokered CDs as well. Here we are at Treasury Direct's upcoming auctions page. If we scroll down, we can see that all the weekly T-bill and CMB auctions are happening as usual. And if we scroll down further, we can see the 2-year, 5-year, and 7-year T-notes will be auctioned off as well this upcoming week. None of these are reopening auctions, so the coupon is still to be determined. This will be particularly interesting to watch after the rate cut. Also on the schedule is this 1-year, 10-month floating rate note, which is a reopening auction. At the time of this taping, here's what the coupon and the expected yield are for the 2-year T-note auction on Fidelity's platform. And here's what the coupon and the expected yield are for the 5-year T-note. And here's what the coupon and the expected yield are for the 7-year T-note. Do keep in mind that all of these numbers can and usually do change all the way up to the time of the auction. For those of you interested in agency and corporate bonds, here's where the highest yielding new issue agency bonds stand right now. For corporate bonds, here's where the highest yielding new issues stand at the moment. And for brokered CDs, here's where the highest yielding new issues are currently. Remember that regardless of whether we're talking about agency bonds, corporate bonds, or brokered CDs, at the time of this taping, the higher yielding ones that are a bit longer out in terms of maturity are generally callable, although some may now have call dates a bit further out in the horizon. So be sure to check out what the first call date might be on those. All right, member super savers and bond course fans, I hope you enjoyed this video and learned something new. And if you want to really get up to speed on bond investing and building out your bond portfolio before rates could potentially go down further, then check out this video here on our 2024 bond courses. I've also linked all the details on our bond courses and YouTube Super Saver membership below this video for your convenience. Good luck to everyone who's planning on picking up some bonds and CDs this coming week, and see you again very soon with more brand new wealth building content for your financial journey.